Welcome to ForexToolShop, the #1 Forex robot reviews and ratings site on the internet.
Money management is a very important concept to any trader. No doubt if you've ever read any prominent material on trading or investing, Market Wizards, Liar's Poker, The Intelligent Investor, the underlying theme in a lot of those pieces of literature is money management and risk analysis. Managing your risk is what keeps you alive. It's what keeps you in the game to place the next trade. If you're not managing your risk, your account can very easily be blown out and you will have to stop trading. So managing your risk is definitely one of the most important concepts in trading. And the best way to manage your risk, especially in Forex, is to do this through position sizing. Now, you may already have a risk management plan that is tailored to your trading strategy, and that's fine as long as you're addressing the issue of risk in some way. But here we're going to show you a very widely used method for handling your risk in trading. And the very first step in this type of trading is to figure out what percentage of your account you're going to risk for every trade that you place. And usually the best risk percentage to take is between 2 and 5% of your account per trade. So you're going to risk in between 2 to 5% of your account for every trade you place. So looking at this account we have on the platform here, we have a balance of $10,000. So if we're going to risk 5% of our account, that's going to be $500. If you're new to trading, you might want to skew more towards that 2% side, and you'd only risk about $200. But for this example we're going to illustrate here, we're going to risk $500 for every trade that we place. So now that we have the 5% of our account we're going to risk, we need to figure out where we're going to get in the market and where we're going to get out of the market. So, looking at the Australian dollar here, we may decide we're going to want to get long at the 86.50 level. So that level is right under the current market, right here, 86.50. We're going to buy the Australian dollar. Now here's what you don't do. What you don't do is say, okay, I'm used to trading standard lots, so I'm going to buy 1.0 of the Australian dollar, and 50 pip stop loss sounds good. Do not do that. Once you find out where you're going to get in the market, let the market tell you where you should place your stop. Using support and resistance, average true range, a moving average, maybe a 200 moving average, but get something from the market that's giving you a valid stop loss. So looking at this chart, I may decide, okay, looking at this support right here, if the market breaks below this level, I'm wrong. The Australian dollar is not rallying, it's falling, and I need to get out of this trade. So looking at this market, I'm going to put a stop at 82.25. So I come in here and I find my level. It's close enough. So now that I know my entry position and my stop, I can calculate how many pips of risk this is. So again, we have the long position at 86.50 and the stop I can know that this is 425 pips of risk. So now I have what I need to answer the million-dollar question, which is, what lot size allows me to handle my risk appropriately? So we know we have $500 we're willing to risk across 425 pips. Now when you divide 500 by 425, you get a value of 1.17. Now that I know I can risk $1.17 for every pip, I know that one mini lot equals $1 a pip, and that one micro lot equals 10 cents a pip. So my appropriate lot size here is going to be 0.11, which is 1 micro and 1 mini. So, and the reason you don't go up to 0.12, which is actually close to our value here, is because when we would go over our $500 risk if we got a 425 pip move to our stop loss. So basically we just round it down. It's always better to err on the conservative side and round down in these situations. So I hope this makes sense to everyone. The way to manage your risk is through your position size, and you need to figure out what the appropriate percentage of your account is and how many dollars you're willing to risk. Then you need to find your entry and your exit should be dictated by the market based on some methodology you're comfortable with. Support and resistance in the case of our example here, moving average, average true range, whatever it may be, to find your total pips of risk. Then you divide your total account, the dollars in your account you're willing to risk, divided by the number of pips you're going to risk. You get $1 per pip amount, and then find the appropriate lot size to trade that amount. Thank you. If you have any questions, feel free to submit them from our website, info@ForexToolShop.com or questions@ForexToolShop.com.